Every single bar on your chart is a trading signal, but 90% of traders ignore the raw data to look at lagging indicators instead. Price action is the study of price movement over time. It requires no indicators, no news feeds, and no fundamental analysis to be effective. It is the purest form of trading because price is the only truth in the market. Many traders clutter their screens with moving averages, RSI, and MACD. These are derivatives of price. They only tell you what has already happened. By the time an indicator signals a turn, the smart money has already entered. The core philosophy we follow here is based on the methodology of Al Brooks. The premise is simple but profound. The market is efficient, and institutions control the price. Your job is to follow their footprints. To understand price action, you must understand the market's purpose. The market is a continuous double auction. It exists to facilitate trade by finding a fair price where buyers and sellers agree to do business. When price moves up, it's not just buying pressure. It means the market is searching for sellers at higher levels. When it moves down, it is searching for buyers at lower levels. This search drives every tick on your screen. Therefore, every bar tells a story about who is winning the battle, the bulls or the bears. In this series, we stop guessing and start reading. We treat every 5-minute bar as a distinct piece of information. Let's break down the fundamental unit of price action, the trend bar versus the trading range bar. Recognizing the difference immediately is the first step to profitable trading. A strong trend bar signifies urgency. Institutions are buying or selling aggressively and are willing to pay worse prices to get filled. This creates a large body with small tails. Conversely, a trading range bar, or a doji, shows equilibrium. Bulls pushed up, bears pushed down, but the market closed near where it opened. Neither side is in control. Why does this distinction matter? Because you trade them differently. You buy breakouts of trend bars, but you bet against breakouts of trading range bars. Context dictates the strategy. This brings us to the concept of context. A perfect candlestick pattern means nothing if it appears in the wrong location. A bullish reversal bar is useless in a strong bear trend. In price action trading, we look to the left. We identify market structure, channels, trading ranges, and trends. We do not use lines as rigid barriers, but as zones where interaction is likely. Let's look at a classic price action cycle. Markets move from trend to trading range and back to trend. Identifying which phase you are in prevents you from buying at the top of a range. Here is a visual example of a breakout turning into a channel. Notice how the strong trend bars eventually get smaller and start overlapping. This is the momentum fading. Indicators often mislead you during these transitions. A moving average crossover might signal buy just as the market enters a choppy trading range. Price action warns you of this immediately through overlapping bars. Another critical concept is the signal bar and the entry bar. The signal bar is the setup, the reason to take the trade. The entry bar is the confirmation that the market agrees with you. Al Brooks teaches that every tick is a test. When price breaks above a prior high, it is testing to see if buyers are still there. If they are, the trend continues. If not, it reverses. This constant testing creates patterns. Double tops, wedges, and flags are not magic shapes. They are manifestations of traders changing their minds or institutions taking profits. Traders often ask, what is the success rate of this method? In price action, probability is fluid. A strong breakout might have a 60% probability of continuation. A counter-trend trade might only have 40%. You must understand the trader's equation. To take a trade, your probability times your reward must be greater than your risk. If you take low probability trades, you need massive rewards. Most beginners lose because they seek high probability and high reward. The market rarely gives both. Usually, you must trade high uncertainty for high reward, or high certainty for smaller reward. We also focus heavily on trap traders. These are traders who entered on the wrong side and are now underwater. Their exit orders fuel our profit. We learn to spot their pain points. For example, if a bull flag fails to break out and reverses down, the bulls who bought the flag are trapped. They must sell to exit. This selling pressure drives the price down fast. Reading these traps requires watching the close of the bars. A bar closing on its high tells a completely different story than a bar with the same high, but closing on its low. Throughout this series, we will dissect charts bar by bar. We will learn to count legs in a trend, identify measured move targets, and manage trade entries using limit and stop orders. This is not about memorizing names like Harami or engulfing. It is about understanding the psychology of the auction. Why did price stop here? Why did it accelerate there? We will categorize the market into 4 types: always in long, always in short, breakout mode, and trading range. Knowing the current mode prevents forced trades. Remember, the goal is not perfection. The goal is to align your trades with institutional flow. If Goldman Sachs is buying, we want to be buying. Price action shows us when they enter. As we move forward, clear your chart. Remove the moving averages, delete the RSI. Start looking at the bars. Look at the highs and lows. The data is naked, and it is honest. In the next video, we will cover trend lines and channels, specifically how to draw them correctly to identify breakout points and failures. This is the foundation of market structure. Trading price action is a skill, like learning a language or playing an instrument. It takes screen time, but once you see it, you cannot unsee it. The market becomes readable. Subscribe to follow the complete course. We are building this methodology from the ground up, 1 bar at a time. Let's decode the market together. Master the market's language, not the noise.